Hey, good morning, everybody. It's Hammer. Today is Tuesday, December 12th, 2023. I am, of course, M. Hammer with Originator Success here at the Daily Rate Lock Conversation, the only place on the web where you guys get to be a part of the conversation. Appreciate you joining me. Remember, you can join me live each and every day, 9:30 a.m. Eastern Time. Let me know if y'all signed up for the text alert for going live, and let me know if you got that one. Good morning, Angela Walters. Good morning, Mike Tebow, Scott Menster. Great to see you all here. Remember, if you're watching on the replay, if you're not here live, go ahead and just give us a hashtag replay in the comments. Let me know that you were here, whether you're on Facebook or on YouTube. Either way, don't forget to smash that like button, tag an LO friend, share us in a group. If you're on YouTube, go ahead and give us a thumbs up and subscribe. Go ahead and remember, you can sign up for our written lock advice. Get it to your inbox each and every day free of charge. www.ratelockadvice.com. Quite a bit on there today. Definitely worth getting that email. You can also sign up for our text alerts, www.ratetextalerts.com. Last but not least, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media. Hope you all are doing well. Who we got here this morning? We got Deb Dickinson. Good morning. John Warner. Great to see you. Tom Dedmore. Good morning. Deb Dickinson, thank you for letting me know that the text message worked. It's going to come from a different number. I set up a new number. That's our billing number. And if somebody replies stop or something, I don't want them to accidentally unsubscribe from being able to receive billing notification emails or text messages. So I do have another number, and but it's going through Twilio and it has to be registered. So good morning, Mr. Siegel. Great to see you, my friend. Dan Crowley, great to have you here. Yes, Megan, good. Please put up the sign up for the live text alerts in the chat. Yeah, I will put that up for you real quick. Let me see. It's hmmr.io/live something. HMMR.live reminder. Okay, there it is. Live reminder. So it's HMMR live reminder. There you go. So that is the link. And I sent out the first text message today, and it definitely did go out. I see it here, and I received it. However, it didn't go out the first time when I sent it from the special number because it has to be registered. So Hammer is going live. Watch the replay later or join now, Facebook, YouTube. I'll dress it up a little bit, but you can sign up for that. And again, you can also sign up for that. It's here at hmmr.io/live-reminder. And you can go ahead and sign up to receive the reminder text. So sorry to spend so much time on that. We'll get that dialed in, but I was just playing with it this morning. So Ken Krug, can you speak up a little? I'm on the treadmill trying to run from my anxiety. It's hard to hear me. Yeah, dude. Well, it's time to be anxious. We've definitely seen a turnaround. I'll talk more about that. I probably should. You know what I'm going to do? I'm going to do something I don't do that often. I'm throw. Here is my email. And we're going to kind of stick to this today as a script, just so I can stay on it. So you'll notice here that I've switched the advice at a glance to cautiously floating. I would be in a lock stance, except for the fact that tomorrow's Fed action is going to happen in the afternoon. So here's today's quote of the day. When I let go of what I am, I become what I might be. Good morning, Cindy Pulliam, Rob Stewart, Megan Lindberg. Awesome. Tim Klyla, Pat Tenney. Good morning, Ms. Pat Tenney. Great to see you here. Haven't seen you in a while. So rate sheets this morning should be similar or a smidge better than yesterday. Here, I'm going to show this. There we go. Okay. Rate sheets this morning should be similar or a smidge better than yesterday. You can see right now, mortgage bonds down 6 basis points. We were up a few basis points. We're ticking up and down, but we're right within that same realm of things as far as where we are here. Coming in at expectations is where the CPI data came in. CPI data came in right as expected. Here, let me make this fit the screen a little bit better. Here, hold on a minute. Come on. There we go. Okay. So here's the CPI data this morning. The CPI month over month, the headline number was plus 0.01. The estimate was 0.0. The core, though, that's the one that matters. The core CPI month over month was plus 0.03, 0.3 rather, and it was estimated to be 0.3 as well. And the other numbers, again, as you can see here, core and headline came in exactly as expected. Today's data underscores the choppy nature of getting inflation back in line. While price pressures have largely retreated from multi-decade highs, a still strong labor market continues to power consumer spending on the broader economy. All right. So basically, when we look at this here, reprice risk on the day is low. Bonds aren't likely to start selling off, but we're also not likely to see much improvement from here. It's generally, we'll see a little bit of improvement that things will hold steady heading into tomorrow's Fed meeting. Now, tomorrow's Fed meeting starts at 2 p.m. Eastern time. Well, it doesn't start. It actually started today, but it concludes at 2 p.m. Eastern time. The Fed fireworks start with the Fed policy statement and dot plot coming out at 2 p.m. And then we're going to have Fed Chair Jerome Powell's press conference at 2:30. Now, we had three big events going on over the last week that I really was hoping and expecting to see that was going to give rates a boost in December. It started with last week's jobs data. The JOLTS data came in okay, but the non-farm payroll, the wages, unemployment, not favorably, right? Showed strength in the job market, came in a little bit stronger than expected, just a little, but a little is enough. The second big event was today's CPI inflation report. Again, coming in as expected, just wasn't enough to excite markets. Last month, we came in 0.1% better, just 0.1%. And that was enough to really start a rally. So we've got two whiffs, if you will, of at-bats, two sacks. I'm in a sports mood today. Two missed shots in hockey, but basically 2 out of 3 things, not good, right? Tomorrow we get the Fed meeting. The problem is we needed good jobs data and we needed good inflation data in order to get a good Fed meeting. It's kind of like math. Good plus good equals good. So whiff plus whiff equals, come on, say it with me, whiff. All right. Nate Joma being live on the replay. Nate, that just shows how talented you are that you pull that off. Amazing on that. So yeah, it definitely tomorrow, I'm not expecting a lot from it. In fact, I'd call it a Hail Mary. So, as I'll repeat below, the only reason I'm not suggesting to lock everything closing in the next 30 days is the Fed action is in the afternoon and we can lock before things get too bad. We're hoping for a Hail Mary from Powell to save the day, but this is unlikely. Ron is pointing out in the chat that tomorrow's wholesale inflation, the PPI, could be helpful. Yeah, but Ron, come on, man. It's like that's like the third row back on the bus. The wholesale inflation, it could help a little bit, but it's not. I mean, it's not going to trigger anything. It's certainly not going to help the Fed. I think we're going to get a lot of the same message that we've been getting from Powell on this stuff, y'all. So anyway, we talked about the inflation data coming in as expected. Not really anything there. We've seen rates whiff on 2 out of 3 opportunities. Talking about that there. Nate said the Dolphins are the equivalent of the Hail Mary from Powell. Did the Dolphins even win last night? I wasn't even paying attention. The Giants beat the Packers. I know that. What a week ago looked like an event that would be great for rates is now lost its luster. If we look at mortgage-backed securities, mortgage bonds, we were killing it. Figures just won't slide. Let me refresh it. We were killing it since the beginning of November. We've had a nice run. Rates have really, really improved since the beginning of November. Remember, at the end of October, at these worst levels here, towards the end of October, these were right here. We were seeing rates that were in the 8s. And now we have pushed back down. We've seen a hell of a rally. Lost a little bit of steam here, but then got some more. I think we're going to run stagnant. There's not anything for us to. We were looking for help from the labor data. We were looking for help from the inflation data. We were looking for help from tomorrow's Fed meeting. Since we're not getting that help and we're basically treading water, the 10-year Treasury yield 4.24. It's right in that 4.25-ish area. Looking at 6 months, you could see like we touched here at 4.11. Back here we were 4.11. So we could draw a line here of resistance at 4.11 for that 10-year Treasury yield. If we don't break below that significantly, 3.0 is off the table. It's unlikely we see that. So anyway, with looking at what we're seeing here, we've talked about rate sheets today. We've talked about reprice risk today. we're cautiously floating, but I think it's important. Let me just, I'll use the data here to come in on this. So here we go. Loans closing in less than 15 days should cautiously float, like I said above. If the Fed action was before pricing came out tomorrow, then I'd be in a locking stance. I just don't think we're going to see a lot of help from the Fed tomorrow. It's a Hail Mary is what we're looking for. It's an onside kick. It's, we're not looking at it. However, since it does come out later in the day, we can hedge our bets, see how it plays out. I no longer believe that we'll see a favorable outcome now that the jobs data and inflation data were a bust, and they were a bust. Be ready to lock these loans, especially if you won't be able to lock them before a negative reaction tomorrow. Loans closing in 15 to 30 days should also cautiously float. However, should be ready to lock tomorrow. Remember, we're going into the holidays, things like that. I'd be locking these up. You're not going to get, it just isn't likely that we see that much more favorable pricing than what we've got right now. Looks like we've seen the best rates we're going to see to end the year. Rates are going to go down a little bit more in 2024, but we're going to need to see signs the economy is slowing down. We're going to need to see signs that the labor market is softening and that inflation is continuing to tick lower. Remember, we were looking at the idea that the Fed was going to cut rates by June and that the first rate cut was vacillating between May and June, right? That's when the expectation was the May 1st meeting, the June 12th meeting. Markets were kind of going back and forth on where they thought things would go first. Well, in the last few weeks, Bill Ackman chimed up and a few others jumped on the boat that we would see a rate cut by March. But remember, this was actually, that was leading, it was the higher probability that we would see a rate cut in March. That has dwindled. It's coming down. It's still pretty strong. There is a 40% belief that we will see a rate cut in March, but unless the Fed were to say something tomorrow to really open that door, and I don't think they're going to do that. I mean, Fed Chair Jerome Powell in his press conference, he's going to reiterate that they want to see that they're committed to inflation coming down, that they're not raising rates, but that they could raise rates in the future. We're going to get the dot plot. He'll be, have to address that a bunch of times, but they're going to talk about the fact that they, the higher for longer is going to start to come back up in the conversation, that the Fed is going to keep rates higher for longer, because looking at this inflation data that we got here, this doesn't really bode for cutting rates. And if we don't, the reason that the Fed would cut rates is because we are seeing a weak economy and the labor market starts to soften and fall apart. Well, none of that is happening. So the Fed has no reason to lower rates until they start to see signs and cracks in the foundation of the economy. We're not seeing that. Not clearly enough, not enough. We've had this conversation before. So it really puts us in a position when you're looking at mortgage-backed securities and mortgage pricing and mortgage rates, like right now we're up 5 basis points. Woohoo. But there's not a lot to get excited about here, y'all. It looks like that this was a bust. The beginning of December, I thought we would see rates get better, and we're still not seeing it. Ron said, still forecasting second quarter 2024 for rate cuts in a recession. So second quarter would be May and June, and that's probably what we'll be looking at. Yeah, that's months away. So Powell will try to cool market with his comments regardless of them holding this time. Yeah, I agree. He doesn't, for those of you that kind of what Ron is saying is, if Powell and the rest of the Fed members, but if Powell were to come out and say that the Fed is going to be, quicker to cut rates, well, then what happens is that speeds up the economy and contributes to inflation, because investors, traders, all piling in on that. And it's, they're looking for that. So it's almost a self-fulfilling prophecy. He doesn't want to fall into that. I think a lot of the messaging we're going to get is going to be, hey, things are not likely to improve much from here. And I think he's going to hold steady on that. So anyway, that's it, my friends. Sorry that we are not seeing better. But the good news is we have seen rates come down significantly over time. Let me just bring this up and go to the rate thing here. Daily rate index. Here you go. All right. So we have seen rates really, really drop from that 8%. But we want it to happen slowly, and having it in waves is good because it helps reduce the chance of EPOs. It's going to allow consumers to come along for the ride. You're able to get some people off the fence. It's kind of like a roller coaster, and then it pulls in, you get some people off, you put some new people on, and then it goes around again. And hopefully that's what we see happen. When you're in a declining rate environment where you have to deal with the concern of commission clawbacks, EPOs, all that kind of stuff, this is the best way to see it, is gradual. And we've seen a very, very big drop over the last 6 weeks. We saw from the 8s to the mid 7s down into the low 7s for Govy stuff. You look here and their quote stuff that's, in the FHA and VA in the low, the mid 6s. That's a great rate right now. These are great rates. So, it allows us to see an opportunity for things to kind of slow down and happen. So, all right, y'all. Well, thanks again for watching. I'm sorry that this morning's news is disappointing. The good news is we didn't see it come in stronger. We didn't see a big sell-off, and you're not having to worry about locking and all that stuff. So it's very, we had 2 whiffs at the at-bats, but at least we didn't lose a lot of ground. Friday with the jobs data, we talked about this before. When you look at Friday's numbers here, we were actually up on the day. After that jobs data, it kind of washed itself out. Today, after the CPI data, kind of washing itself out. It's just the status quo. That's not terrible. So anyway, keep that in mind. I'll see y'all later. Remember, you can sign up for those text notifications if y'all want here at hmmr.io/live reminder. You can see it on the screen. I'll give you a QR code if you'd like to get a text reminder when I'm going live. I've put that into place finally, and we've got those going out. The first one went out this morning. So remember, I'll be changing that phone number. I'm waiting for Twilio to approve it. So, all right, y'all. Well, that's it. I hope you guys have a fantastic day. We'll see you tomorrow. We'll talk more about the Fed tomorrow. Take care, everybody. Bye-bye.